This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Other than exempt transfers made in lifetime, the two types of lifetime transfer that may create chargeability to IHT go by the name of, as we see here, firstly CLTs, chargeable lifetime transfers, and then of course PETs, potentially exempt transfers. CLTs, as we know, are, and hence it gives rise to a computation in that name, lifetime transfers that are chargeable when made. As they're chargeable when made, we don't wait around and to see whether the taxpayer dies within 7 years of having made them. They are chargeable at rates in force at the date of the transfer. So wherever in lifetime it was made, we use the nil rate band then. It's the only one we would have known at that point in time. But that's the first occasion of charge and at the lifetime rates. We know what the lifetime rates are. It's a gross rate of 20%. That tax will be paid on the excess above the available nil rate band at that point in time. That will be paid at 20% if the tax is payable by the donees. If on the other hand, and it would be the assumption made unless told to the contrary, if the donor paid, then it would be taxed at 25%. Only, of course, if we've gone in excess of the available nil rate band at that point in time. But then, should the taxpayer sadly die within 7 years of having made that CLT, then in addition to the lifetime tax, we now get chargeability on death. Now, that will only take account of any additional tax that may become chargeable on CLTs, and as we've said, only those that take place within the 7 years before death. Anything more than 7 years prior to the date of death will not be chargeable as a result of the death of the taxpayer. However, and what is the main point of this particular session, though when a taxpayer dies, say 9 years after having made a CLT, though that CLT itself will not be chargeable as a result of the death because the taxpayer survived for the minimum required 7 years. The fact that that CLT exists 9 years back and that it was chargeable when made will therefore, and remember, tax IHT is a cumulative donor-based tax, that CLT of 9 years before date of death, though it itself is not taxable, it is not chargeable in its own right, it may affect those transfers that are chargeable on death, those that do fall within the 7 years of the date of death. Because as we've seen, we have this 7-year cumulative clock. So if there is a CLT made 9 years before death, it is not taxable on death, but it would impact on those lifetime transfers that fall within the 7 years of the date of death, but fall within 7 and 2 years of the date of death. Why 2 years? Because that is 7 years on from when the CLT took place. CLTs have a cumulative effect for 7 years. If you make a further transfer within 7 years of a CLT, then in taxing that particular transfer, you have to take account of the previous CLTs over the prior 7 years. It's that issue that is the most potentially awkward one to deal with, and we'll illustrate that in a moment. But to begin with, what do we know? CLTs are chargeable when made at the rates in force when made. They are then chargeable on death, any additional tax due on them, but only of course chargeable on death if the death occurs within 7 years of that CLT. PETs become chargeable for the one and only time on death. No immediate charge to IHT when made, and only chargeable on death if within 7 years of death. Now, if, as we saw back in illustration 6, earlier on in our studies there, you may or may not recall it, but in that one I gave you a PET that was about 8 years before the date of death. Now that one was not chargeable when made, is not chargeable on death, therefore it will have no effect in relation to our chargeability to IHT. The only thing that it may have done is to have used annual exemptions, if of course it was the first in the tax year. It may have used annual exemptions of that year and maybe the previous year that might otherwise have gone against a CLT. But other than that, it has no impact. It was not chargeable when made. It is not chargeable on death. It is therefore exempt. So let's have a little example here to illustrate this point of this 7-year cumulative impact in terms of our CLTs made in lifetime. Right, if again you make a note of the following. Taxpayer died on 1st of January 2015 with a chargeable estate of £1 million. Chargeable transfers, note that term, chargeable transfers, made in lifetime were. Now I've used the term chargeable transfer. Remember, the very first exercise you do in dealing with an examination question is working, it is indeed a working of the chargeable transfer figures. That's where, chronologically, you'd have a column across the right-hand side of your page for each PET or CLT that is either chargeable when made or chargeable on death. And you would work in that from the transfer of value less any relevant exemptions, like the marriage exemption, like the annual exemptions there. So these figures I'm about to give you are those bottom line chargeable transfer figures. So when we go into the computations in a moment's time, don't start thinking, but you've forgotten to deduct the annual exemptions. I have given you the chargeable transfer figure here, not the transfer of value. Effectively, that working has already been done. And for the 1st of August 05, we have a CLT £295,000. Then 1st of December 10, you'll note that is within 7 years of August 05, a PET, 200,000. Then again, still within 7 years of that 1st of August 05 transfer, that CLT, another CLT for £145,000. Now with CLTs, of course, we need to know who is going to pay any lifetime tax that may fall due on either of these CLTs. We're told any lifetime tax payable was paid by the donor. Even if I had not given you that statement, that is the assumption you would make. You'll only take it that the trustees, the donees, would have paid the tax if you were specifically told so. Now we've got a CLT back here in the 1st of August 05. Therefore, we need to know the nil rate band in 05-06. That, I tell you right at the bottom here, is 275,000. Now there's another CLT, of course, here, 1st of September 11, but since April 09, we've had the 325,000 nil rate band. It was around since 09-10 tax year, and we still have it, of course, now applicable at the date of death in our 14-15 tax year. So the only other nil rate band we want is 05-06. Okay. First calculation, therefore, first computation, having already got these chargeable transfer figures, we then need to look at and ask, are there any CLTs? Yes, there are, there and there, and we therefore have to do the computation headed lifetime transfers chargeable when made. So let's set that up. Lifetime transfers, chargeable when made. Now you should by now, if you've revised back through the previous sessions when I asked you to do before this one, we should know that it is only CLTs that go to this computation, the lifetime transfers chargeable when made, and we'll run on our working anyway 3 columns, a little inside working column there, a gross column, and then a tax column for the IHT, if any, to be paid. We're only here concerned with CLTs, so what have we got? The first of the CLTs dated 1st August 05, CLT, the amount of the chargeable transfer, 295,000. Into your working column it goes. Back in 05-06 we were told that the nil rate band was £275,000. So this transfer is 295, so we've gone above and we'll use all of the then nil rate band, 275,000 times nil, but it still leaves, of course, a further 20,000, we've got 295 here, to be taxed at. Now, who paid the tax? We were told the donor pays the tax. So what is the tax rate above our nil rate band? 25%. 20,000 at 25% will of course be £5,000. Into the tax column it goes, 5,000 to be paid. Remember, by the donor. Because this 295 is a net transfer, we need to accumulate in this cumulative rolling total column that we have, this gross column, we need the gross figure. So that must be 300,000, just the net plus the tax. So we're off and running that in relation to the August 05 CLT, £5,000 worth of inheritance tax would have been payable, and that was payable by the donor. Well, after that, what happened? Well, there was a PET, of course, in December 10, but did that have any impact for us? All it would have meant that the annual exemption for the 10-11 tax year and the preceding year 09-10 tax year would have been used to derive that PET. So we'd have deducted the £6,000 worth of annual exemptions in getting the chargeable transfer given to you at £200,000. But it was not chargeable when made, and had the taxpayer only gone on to have lived for the required 7 years, would never have been chargeable. So that one does not come onto this computation, only CLTs. The next CLT, there was one further one, on the 1st of September 11. The amount of the CLT, £145,000. Now we've moved forward to the 11-12 tax year. So we need to know that the available nil rate band, is the current level, 325, minus what has been used so far. What has been used so far, and therefore will not be available against the 145, we have got 300,000 so far on the clock. So 325 minus 300 equals 25,000. So our available nil rate band, what is the nil rate band at this date? What have we got on our gross clock so far? What is the difference between them? 325 is the nil rate band at this date. 300 is the amount deemed used, even though at the time that gross 300 arose, the nil rate band was not then 325. I'm afraid we don't get the bit in between. All we can do now is to say 325 compared to 300, 25,000 of this transfer is therefore at nil. Well, that's 25 out of the 145,000. So that will still leave therefore 120,000. Again, remember we said the donor pays the tax on these transfers, so it's 25%. 25% of 120 is, methinks, £30,000 of tax to be paid. Once again, it was a net transfer, so the gross figure, the combination of the net plus the tax, well, that would look to be £175,000. At that point in time, your cumulative total would have been £475,000. Now, it wouldn't have stayed at 475 forever, because this transfer on the 1st of August 05 only has a cumulative effect up until, well, 7 years from that, and that would be the 1st of August 2012. So at that point, had we had further CLTs, although following the 175 transfer, the cumulative total was 475, on the 1st of August 12, that CLT would have been removed from this computation. It would no longer continue to have a cumulative impact. We can see the impact that that 300,000 has had on this transfer here. It's meant there was only 25,000 of the nil rate band available to go against the 145,000 transfer. So after 7 years, it's run its course and therefore it's removed. So that means we take away the 300,000 and that would put you back to 175,000, opening up again from that point some nil rate band. Now, there'll be no point in doing this on this computation here because there were no more CLTs, and before any more CLTs could ever be made, sadly our taxpayer died. So we don't need to do that removal from this computation. But I want you to be aware of that, because where we go next, looking at lifetime transfers chargeable on death, this is going to be a relevant point. Okay, well, we've worked out the lifetime tax that was payable in each case by the donor, and now we must move on to look at, again, the trickier one of the two computations in terms of, lifetime transfers there. Let's just, while we're here, set up another page, shall we? So that we've got room to put this computation in. Okay, so let's set it up. Lifetime transfers, as we said, chargeable on death. When did we kill our taxpayer off? The 1st of January 2015. Two columns needed, just the gross and the tax columns now. And how do we do this? Well, by reference to the date of death, the 1st of January 15, how far back do we go in terms of what is taxable? We of course go back 7 years. So going back 7 years from the 1st of January 15, we go back effectively to the 1st of January, what will that be? 2008. We then come forward from that date, looking for the first lifetime transfer within the 7 years before the date of death. That is what we've done so far. That's again what we do. I'm just going to ask you though, before we put that in, to do one thing. And that is to just leave a gap of 2 or 3 lines at the top of this computation before putting in this first transfer. Now that was the 1st of December 10 transfer, the PET that had a chargeable transfer figure of £200,000. So just put that in, but leave 2 to 3 lines above it. The reason being, we keep saying it, don't we? IHT is a cumulative donor-based tax. From our very first looking at lifetime transfers, we realised that a lifetime transfer such as this one, £200,000, could not be looked at in isolation, because that 200,000 may all be covered by the nil rate band, it may be fully chargeable at 40%, or it might be partly covered by nil rate band and partly at 40%. Now, up until now, this transfer that you see here would have been the very first transfer. We only dealt with transfers that fell within the 7 years before the date of death, other than PETs that predated it, which were ignored. They were exempt anyway. But what we cannot do is to ignore those CLTs, because although the CLT that occurred in the 1st of August 05, although it is more than 7 years before the date of death, so it will not be taxable, that 300,000 gross figure that we computed on our previous computation, that was within the 7 years of this date. So in taxing this £200,000, we have to look to see whether, in relation to this computation, we've got here any CLTs that were in the prior 7 years to that date. Now, the 1st of December 10, 7 years back, would take us to December 03. And yes, we do have a CLT dated 1st of August 05. So that 300,000 gross is brought in as like a brought forward figure here, but one that is not taxable. Now, it doesn't matter that the figure is only 300,000. Whether it was 300, 400, 500 or 100, whether above or below the nil rate band is irrelevant. There will be no tax. We will just put a line in there because it is not chargeable. But that's not the point. Though it is not chargeable, look at what it does to this 200,000 here. That 200 is now put on top of that 300, giving a cumulative total of 500. So just as we were seeing when we were playing with these lifetime transfers before, that means that most of this 200,000 is pushed out of the 325,000 nil rate band, because, like it or not, that 325 is deemed to have already been utilised by the 300,000 transfer in August 05, even though it now is not chargeable on death. And that is the hard thing to get your head around. But because it's a cumulative donor-based tax, that CLT was chargeable when made, it was not ignored, it was not a pet, and that therefore influences the tax now payable on the December 2010 pet. It means that only 25,000 of that pet will be at the nil rate band, pushing the remaining 175,000 up into the 40% band. So 175,000 at 40%. Well, I think therefore that will be, do check it, but my mental arithmetic is right, £70,000. Now have a look at what we've done. The December 10 pet is the earliest transfer within the 7 years of the date of death. It is the first transfer to be taxed as a result of the death of the taxpayer. But we cannot look at that in isolation, and if and only if there were CLTs, as there are here or as there is here, only if there are CLTs made within the 7 years before it, do we now bring in onto our gross clock this sort of brought forward figure. The sadness is, of course, that it's deemed now to have used up that amount, 300,000 of the nil rate band, and that pushes 175,000 into the 40% band. Now there is at least some slightly better news, inasmuch as we won't have to pay, or the donee indeed of that pet will not have to pay the full £70,000. Why not? Well, look at the timing there, December 10 compared to January 15 date of death. So what therefore will be available? Taper relief. Let's just go over the page to show, that less taper relief here, and the taper relief we said, well, that we didn't say, did we? But that is going to be, look at the dates, I'll take you back, December 10, January 15, count forward, December 10, 11, 12, 13, 14, don't get to December 15, so the taper relief is based on between 4 and 5 years. So taper relief 4 to 5 years, so that will be 40%. 40% taper relief, take that away from 78,000, that I think is 28,000 there. Take that away, and your tax to be paid, 28 from 70, I think that must be £42,000. Now remember what figure you've got coming forward on your gross clock. I'll just put it in there. On your gross clock, you've got £500,000 at this point in time in December 2010. Okay, now if we can crack that, then basically we're almost there. Go forward now from this starting point. We've dealt with the December 10 pet. The next relevant date is the 1st of September 11, where we had a further CLT. A CLT whose chargeable transfer, go back to the previous computation, whose chargeable transfer amounted to 175,000. What is on the taxpayer's clock at this point? 500,000. Now, a word of warning. I've just put in that September 11 CLT, but I needed to know that my cumulative total at September 11 date was still £500,000. Now it was, because when we look back, we can see that that 300,000 was dated August 05. So, as we said, it will be around until August 2012. So at the time this second CLT was made, that earlier CLT was still within the 7 years before that date. Again, most unfortunate, because it means that all of that 175,000 is up in the 40% band. So the entirety of it is at 40%, and 40% of 175 is, again, methinks, well, it's going to be £70,000. But we don't have to pay that. No, because again, what is available first of all? Taper relief. Now, September 11, date of death January 15, so count forward from September 11, September 12, 13, 14, we made it for at least 3 but not 4 years. So 3 to 4 years, and that level of taper relief is of course 20%. 20% of 70 is 14,000, take it away, 56,000. So is that what we pay? No, because on a CLT, what did we have? Lifetime tax paid. So we do get to credit back any and all lifetime tax paid, which here amounted to, if you look back to the computation, £30,000, bringing us down to £26,000 as the additional tax that will now be due on death. That is the additional tax due on death. Now at that point you'd have £675,000 as your cumulative total over the 7-year period up to September 11 there. Now there were no other lifetime transfers, but £675,000 is not the cumulative total on the taxpayer's clock at the date of death, back in or up in January 2015. Because remember what we said, that those CLTs are only going to have a cumulative effect for a 7-year period. So on the 1st of August 2012, 7 years after the 1st of August 05 CLT, that CLT, dated August 05, is removed. That was 300,000. But sadly, it's going to have no favourable effect in relation to your death estate, because when you take out 300 from 675, it still leaves you with 375. And what that should tell you is that 375 is still bigger than what? Well, it's bigger than a lot of numbers, I know, but specifically bigger than 325. So it does not serve to open up again any new nil rate band. So what does that mean? It means all of the chargeable estate at death, the full £1 million, would then be chargeable as a result of death. You'd have shown your computation of the chargeable estate. You'd show that the available nil rate band at the date of death was nil, given that the transfers in the 7 years before death total 375. So your chargeable estate would be, I'm not going to bother to write it in, but it would be 1 million, the chargeable estate, all at 40%. A very easy calculation, therefore, some £400,000. And thus the job would be done. Okay, so let's see how we get on, therefore, dealing with an example that includes one of these problem issues, a CLT made more than 7 years prior to the date of death. So here we go with example 2. What are we required to do? Part A of the problem, calculate the IHT payable on the lifetime gifts when they were made. Now, IHT payable on lifetime gifts when they're made means CLTs, and therefore just transfers into trusts, assuming that D paid any lifetime tax due. What does that mean? It means that any CLT was a net transfer. We're therefore going to have to calculate the tax above the nil rate band at 25% and add that tax figure to the chargeable transfer in order to establish the gross chargeable transfer for cumulative purposes. Once that is done, then to calculate the IHT payable as a result of D's death. So, what are we told happened in the question? Deceased, dear, it gets worse. Deceased died on the 1st of March 2016 with a chargeable estate of £500,000. So we've shortcut the exercise of writing out all the assets at their values at the date of death and deducting those liabilities and any exempt bequests there by just giving you the chargeable estate. Again, it'd be worth a few more marks for you to do that calculation of the chargeable estate as we did in the previous example 1. But here it's been done for you. Our focus of attention is of course on these lifetime gifts. So what have we got? Read through the question as we would in the situation of the real exam, noting up on the question page the types of transfer we're dealing with. So 1st of October 03, £100,000 cash to son. Gift in lifetime to son, that equals a pet. We look at the date of it. It's the 1st of October 2003. D did not die until March 2016. That therefore means that the pet, potentially exempt when made, no IHT payable at the time, has no IHT payable on it at all. We've lived for the required 7 years, and therefore that pet is exempt. Potentially exempt when made, exempt by the date of death, because the taxpayer survived for the required 7 years. The only thing we're going to have to take account of here, given that this was in 1st of October 03, and would be deemed at the time to have used any available annual exemptions. Now I'm flagging that particular point up because then 1st of June 04, that is in the 04-05 tax year, again more than 7 years before the date of death, but this time it's a transfer into a trust. That therefore makes it a CLT. That therefore means that it cannot and must not be ignored. We're going to have to deal with, as the question has asked us to, the IHT payable on the lifetime gifts when they were made. That is going to be here on this June 04 transfer into trust. It's the only CLT we have. The reason being the next transfer in September 10 is a transfer to the daughter, and that therefore will be a pet. Now, when we've identified the type of transfer, remember there are any of 3 types of transfer that may exist that you're told about, being gifts in lifetime made by the taxpayer. Either of the 2 here, and these are the most likely ones, pets or CLTs, or of course the 3rd type, exempt transfers, i.e. transfer to a spouse. Hasn't happened here. The first pet, October 03, is going to be exempt. Not chargeable when made, not chargeable on death, exempt. But it would have used up the annual exemption for 03-04. Even though that was never going to be a chargeable transfer, as it turned out, it would still be deemed to have used the 03-04 annual exemption. So when it comes to June 04 and the transfer into trust, the CLT, it means that available on it will be only the annual exemption of 04-05, as 03-04, as we just said, would be deemed to have been applied to the pet, irrespective of the fact that it was not chargeable when made, nor did it ever become chargeable, because the taxpayer lived for the required 7 years thereafter. So just the one annual exemption to put against the CLT. On to September 2010, it is a pet, and of course there are annual exemptions available here. The date, September 2010, so annual exemption for 10-11, and then also of course for 09-10. If I can just write over that CLT note there. The AEs, the annual exemptions for both 10-11 and 09-10 will be available. Now remember the technique that we had to follow, the steps that we needed to take to deal with our computational answer. Job 1, step 1, was a working in which we compute the chargeable transfers that will be relevant to us in relation to the exam question. Now here there are only 2 chargeable transfers that are relevant to us, that being the June 04 CLT and the September 2010 gift to daughter the pet. The original October 03 pet, as we've said, is not relevant to us other than the fact that we know that it will have used up the 03-04 annual exemption. So I'd like you to do that first step, please. Put together the computation of chargeable transfers, and having done so, we'll then attempt to compute the first figure of taxation, that is on the computation headed lifetime transfers chargeable when made. But again, we'll sort that out together once we know we got the correct chargeable transfers figures. So pause at this point and please carry on and work those chargeable transfers for me. Okay, well, hopefully you're looking at a working something like this, therefore, in relation to our chargeable transfers. The only two that we need to recognise here for purposes of the computations that we need to do is the June 04 CLT and the September 2010 PET. Pick up, of course, straight from the question to begin with the transfers of value. The transfer of cash into the trust was 278 and the cash to the daughter was 296. We've already identified what exemptions are then available. Back in June 04, just the 04-05 annual exemption, and then against the PET in September 10, firstly the 10-11 annual exemption, followed by the unused annual exemption brought forward from 09-10. Take them away and we get our chargeable transfer figures. So there's step 1. Step 2. Are there any CLTs? Yep, we have got a CLT here in June 04. Therefore, in relation to it, and as per the requirement on the question, to calculate the IHT payable on the lifetime gifts when they were made. No IHT payable on the PETs when they were made, only on the CLT. Hence our computation, I trust we recall the title of it, Lifetime Transfers that of course were chargeable when made. Now to this, as we know, we allocate only the CLTs, there is but one of them, and we need 3 columns. A column in which first of all to record the amount of the chargeable transfer, that will be here the 275,000, then to establish in relation to it the amount of gross transfer, and also to record any tax that may be payable thereon. Now of course there was only one CLT, as we've said, that was made, so we record that information, the date of the transfer, that was the 1st of June 04. We know as it must be here a CLT, and we know the amount of the chargeable transfer, it was £275,000. In it goes. On lifetime transfers chargeable when made, we can only use the rates that were in force at that point in time. Well, that was back in 04-05, and we see here the nil rate band in 04-05 to be 263,000. You may note that they also gave you the nil rate band in 03-04. That was simply allowing those foolish enough to do it to include PETs and make chargeability to tax on those using the rates in force at that date as well. That, of course, we do not do, and hopefully none of us would have fallen for that. So expect to be given that information even though you do not need it, allowing the foolhardy to go ahead and then make that mistake. We're interested purely with the CLTs in terms of the nil rate bands in force in lifetime. So 04-05 it was 263. Well, the amount of this chargeable transfer is 275. Therefore, in terms of our calculation of tax, as ever, the extent of the nil rate band, here 263,000, at nil, and very surprisingly equals nil. But this chargeable transfer, as we've said, is 275. So that means we've got a further £12,000 now to be taxed at. Now, of course, it is at this point in relation to a CLT that we need to know who pays the tax. You may recall from the question, assuming there that D paid any lifetime tax due. D is the donor, that makes it a net transfer, and that makes it a 25% tax rate. That, therefore, will be £3,000 as our tax charge. Right, into the IHT column, £3,000. Now this was a net transfer, so the gross transfer will be the combination of the chargeable transfer, as noted there, 275, plus the tax of 3, so it's £278,000 as that gross chargeable transfer. Now that, of course, was a long time ago. we would be dealing now with the death of the taxpayer in, when was the death of the taxpayer? In or on the 1st of March 2016. Now we still need to know, of course, the amount of that gross chargeable transfer, the 278,000, back in June 04. Not, of course, because it will be taxable on death, because it won't be. It was chargeable when made. It went into this computation. But as we well know, we managed to survive for more than 7 years after the date of that CLT, the 1st of June 04. So there'd be no additional tax. But our problem, and hence the reason for having to do this computation, is that the one lifetime transfer that does fall within the 7 years before the date of death is this PET, dated September 2010. But that date, September 2010, is within 7 years of this date of the CLT, June 04. So it means that when in a moment's time we put together the second of the two computations required dealing with lifetime transfers, that being headed lifetime transfers chargeable on death, that in calculating the amount of tax on this chargeable transfer here of 290,000, we will need to take account of the fact that in the 7 years before it was this 278 gross chargeable transfer, the CLT, and that therefore will be deemed to have used up £278,000 of the nil rate band that would otherwise have been available to use against that PET. What will it do? It will therefore push the majority of that PET of 290 out of the nil rate band and up into the 40% band. So it's that computation that we need to attempt now. So over we go, and we'll now head up lifetime transfers chargeable on death. Now the lifetime transfers chargeable on death, again as we've seen, we killed off our poor old taxpayer deceased on the 1st of March 16. We'll need two columns to record the gross transfers and the amount of IHT payable thereon. So get that set up. If you need to, pause and go back and look at the exercise that we did earlier in this session with the made-up example I gave to you about how we set this up. Now, if you're okay at attempting this, if you haven't already, let's have a little look at what we do. Now, we know that the date of death was the 1st of March 16, so we go back 7 years, that would take us back to the 1st of March 09, and come forward looking for the first, and as it transpires here, the only transfer that occurred in lifetime within the 7 years before the date of death, and the one lifetime transfer that will therefore become chargeable on death. But before we write that in, we just leave a space of maybe 3 or 4 lines and then record that PET. Now that PET was the 1st of September 10. It was a PET. The amount of that chargeable transfer was £290,000, a figure we already have in our chargeable transfer working. But as we have just said, in taxing that 290, unfortunately, it won't be able to utilise all of the available nil rate band at the date of death, i.e. 325, because unfortunately there were CLTs or a CLT within the 7 years prior to this PET. That being dated, there, this 1st of September 10, that one being dated back in, when was that CLT? Bear with me, that CLT dated June 04. So that therefore is the starting point in knowing the tax rates now to apply to the 290,000. What was that figure of chargeable transfer? It was £278,000. Now whether 278 or 378 we said, there will be no additional tax charge on that old CLT on the June 04 CLT. The reason being, as we know, we have survived for more than 7 years from that date to the date of death. But because maybe, again, in looking back in hindsight, it was not a clever idea to have made the PET in September 2010, i.e. within 7 years of the CLT, because it meant, as we see now, that if that PET became chargeable because the taxpayer died within 7 years of it, then the taxability of that 290 would be affected by the earlier CLT. If we'd waited until the CLT was more than 7 years old and then made the PET, then the CLT would have had no impact at all in the taxability of this PET. But that didn't happen, nor indeed as it would be happening in your exam question, because it's exactly this that the examiner would be seeking to test on you. So when we add 290 to 278, that I think will take us up to 568,000. Clearly a figure that is in excess of the 325,000 nil rate band. So how are we going to tax that 290? First of all, how much nil rate band remains? So our available nil rate band at that point, we started with 325, we're deemed to have used 278,000, and that therefore would leave us with, we'll take 278 from 325, that will be, what's that, 47,000. So on the taxability of the 290, 47,000 would be at nil. 47,000 out of the 290, leaving 243,000 to be taxed at 40%. 243,000 at 40% will be equal to, I think, £97,200. We could have got the same answer by simply picking up the total, 568, and removing from it there the available nil rate band of 325. That too would have left us with 243,000, all being out of the 290 PET in September 10, taxable at 40%. So let's put in our tax charge of 97,200 as just computed. But of course, the donee of that PET will not have to pay out all of that 97,200 because we will reduce that tax charge. For what will we reduce it? We will of course reduce it due to the availability of taper relief. So less taper relief. So the taxpayer died on the 1st of March 16. This transfer was the 1st of September 10. So let's see between how many and how many years did we survive from the date of the transfer through to the date of death. So from September 10 we count forward. September 11, 12, 13, 14, 15. So we got to 5 years, but we didn't make it to 6 years. So it's the taper relief of between 5 to 6 years. And when we look that up on the table, we will see that that reads 60%. So we take away our 60% taper relief, 60% from 97,200. Let me just look that up, if I can find the answer. Yeah, there we go. So that, I think, do check the numbers please, will be 58,320. Take it away, and we're left with £38,880 as being the tax now due in relation to that PET. That now is the tax due on the PET. Remember, it's paid by the donee and should be paid within 6 months of the end of the month in which the death occurred. Okay, now there were no further lifetime transfers between that one and the date of death, so we may well think, and we could indeed just end the computation at that point. And that would leave us with just one more computation to do, and that would be the chargeable estate at death. But what we will then need to know is whether at death there will be any available nil rate band. Now at the date of death we will only be utilising the nil rate band on those transfers that occurred within the 7 years before the date of transfer. So the cumulative total on our clock of gross transfers here by the date of death is not the 568 total that it was in September 10. That earlier CLT, you will recall, the earliest CLT was back in June 04. It only has a cumulative effect for 7 years. So 7 years on from June 04, the 1st of June 04, would take us through to the 1st of June 2011, at which point that original CLT will cease to have a cumulative effect. So at that point, we would remove that CLT and update this total of 568. Now we're obviously removing the 278, and that therefore will bring us back to the only other figure that will remain, and that will be the 290. The reason why we need to know that, because now at the date of death, having calculated the having calculated the chargeable tax on death on the lifetime transfer, the 38,880, the last calculation is, as we know, to compute the amount of tax due on the estate at death. To do that, we need to know how much of the nil rate band remains available. So, what transfers occurred within the 7 years before death? 290. So at £290,000, therefore, that would mean of the 325, we've used up 290. So on your chargeable estate at death, you would of course have your exam answer, a proper calculation and presentation of the chargeable estate. But we know that that chargeable estate was 500,000, and we now know that the first 35,000 of it is able to enjoy the remainder of the nil rate band, having accounted for £290,000 deemed to have been applied against the earlier pet. Irrespective of whether it was not, it is deemed to have happened. So what remains? 35,000 at nil, obviously nil. Out of the 500,000 chargeable estate, it will therefore leave 465,000 to be taxed. Now, the only rate then applicable on death, 40%. 40% of 465 is, I think, £186,000 worth of tax that is now due to be paid by the personal representatives, and again by 6 months after the end of the month in which the death occurred. Right, what I'd like you to do now, please, is to thoroughly review through the answer to this particular example. And once you've done that and you're happy with what we have seen here, we'll then move on and deal with the final little section, which, as you can just see creeping in at the bottom there, is just a little bit about Iht planning and the interaction of Iht with another capital tax, that is CGT. Indeed, such as we mentioned briefly at the very beginning of our study of Iht. So just pause at this particular point, please, and then we'll come back and finish this off. Okay, last issue therefore to consider. Iht planning. How do we do that? None of us know when we're going to die. However, we all do know that we are going to die. Yeah, I've got very bad news for you guys out there. We're all gonna die. Obviously, some of us older ones, rather more earlier than you younger ones, no doubt there. But no matter, we're all gonna die. So, think about what would happen if we keep all of our assets until we die without making any lifetime transfers. Then they will all be recorded within the chargeable estate. So they'll all be in the chargeable estate of the taxpayer. And as soon as we have used up the nil rate band, the tax rate is 40% above that nil rate band. That therefore means a huge amount of tax would be payable out of the estate. We're going to lose 40% on the excess above 325. That's a lot of money going to HMRC rather than presumably to our kids, the next generation, who we'd prefer to have it. On that basis, therefore, making lifetime transfers is the easiest way that an individual may be able to reduce their IHT liability that would otherwise arise upon their death. Now, to be able to make lifetime transfers, of course, this assumes that the individual has both the capacity to gift and a willingness to make such gifts. Those who are better off are in a better position, of course, to be able to part with larger amounts of capital, as they've still got significant amounts of capital to keep them in the manner of life that they would like to lead for the rest of their days. But again, we've got to work from a basis of initially advising our client about how much money do you need to be able to maintain the standard of living that you would wish to maintain for the rest of your days. Only then may we be able to determine any excess capital that we may now therefore consider gifting in lifetime rather than keeping until we die. But again, think about the benefits of making these gifts to individuals. So gifts to individuals that are normally pets, we know, would only become chargeable if the donor dies within 7 years of having made them. So here is your basic, main, simple method of planning to avoid IHT. If we can, if we are able, give away in lifetime, we hope we live for 7 years, and then when you die, that transfer will entirely avoid any IHT liability. What was potentially exempt when made will have become exempt after 7 years have elapsed. But what about, as there are no guarantees here, if you don't survive for the required 7 years? Well, if the individual does die within 7 years, the value of the transfer is frozen at the time of the transfer. It is therefore beneficial to gift in lifetime those assets that are likely to increase in value over time. Now, of course, there are never guarantees about what may happen to the value of certain assets, but if we have what we believe to be appreciating assets, then again, gifting in lifetime, even though it transpires you don't live for 7 years, would be worthwhile. For example, if I have an asset now that is worth £200,000 and I give it away, but sadly die within the next 7 years, the value to be taken account of on the pet is £200,000, the value now at the date of transfer. Had I not given it away but kept it until I died, by that date maybe the value of the asset had increased to £250,000. Well, it would then be £250,000 that would be included within my chargeable estate at death and charged then to tax at 40%. This way, the worst that can happen is it's the value now at the time of the transfer, the lower value of £200,000, that eventually becomes chargeable. And having said that we have not survived for 7 years, hence it has become chargeable, any tax charge thereon, so long as the donor does survive for at least 3 years, then any tax thereon will be reduced by the available taper relief there. So there, 3 good reasons for giving in lifetime. And of course, there are other gifts that we could make in lifetime that will never be chargeable to IHT at all, no matter when you die. If, for example, an individual makes regular lifetime gifts to others out of his income, normal expenditure out of income, we know, is exempt. So those transfers exempt as normal expenditure out of income. In addition, of course, the taxpayer has available each year an annual exemption. Not a huge amount, only £3,000, but again, if we have a capacity and a willingness to do it, there's £3,000 that can be taken out of our estate, reducing therefore our eventual chargeable estate by at least that sum that would otherwise have been taxed at 40%. Every little helps. And of course, people to whom we may gift may get married, and therefore we could take advantage of the marriage exemption by making gifts to them on the occasion of their marriage. All of these transfers would allow us to reduce the estate at death without creating, or at least by reducing, any charge that would otherwise have been experienced at the date of death. Now, again, the questions that we get at this level will tend to be discrete in terms of the tax. They're getting a little bit more interesting, and the only point I would make here is that we have said that gifting in lifetime is the way by which we may seek to mitigate, if not indeed entirely avoid, an IHT liability that would have otherwise arisen at the date of death. But we have to be a little bit careful, because when we give advice in practice, we have to consider not just one tax, but all taxes that may be impacted by our advice that we give. So if we give in lifetime, be careful about what assets you do give, because we know, going back now to our study of CGT, that a gift in lifetime represents a chargeable disposal. So if the asset being gifted is a chargeable asset, then gains may arise. So we don't want to therefore create a further tax charge in seeking to avoid another tax charge. So we've got to be careful about what assets we give and when we give them. Now, of course, not all assets are chargeable assets for purposes of CGT. You may recall there's a list of exempt assets, cash being the most obvious one. So any amounts of cash could be gifted in lifetime in order to mitigate your future and eventual IHT liability. You need have no worries about any capital gains tax liabilities, because cash, when gifted, is not a chargeable, it is an exempt asset, so no possible gains could arise. You could still give away chargeable assets in lifetime, and gains may well arise, but of course, remember there we have a rather more significant amount of annual exemption, an annual exempt amount of, currently anyway, £11,100. So we may be able to give away significant value of assets while not experiencing significant gains, and as long as we keep those gains down to the level of the AEA, then there'll be no CGT to pay either. But that type of exercise is much more the domain of the advanced tax paper, P6, should you eventually choose indeed to go on and do that exam paper. But for now, what you need to do to follow up what we have been doing together is, as stated here, read through the technical article written by the F6 examining team on inheritance tax. There were at least a couple of parts of that, though how many parts it comes to on your computer, I can't remember. But read the IHT Acts, plus the Finance Act 2015 article as it impacts on IHT, which is very, very little indeed. Once done, you may then attempt practice question 38. After this, there's just one other main tax still to do and one further chapter, and that is VAT. And that awaits us in our next lesson together.